Okay, so we've been hearing this a lot lately, and understandably, because the market continues to drive all-time highs and continues to surge forward. But everyone has this comment about markets are being becoming a little bit unpredictable. They're frothy, they're overbought, and everyone has this very strong stance that the market is expensive. But yet, when we ask folks, what are you doing about it? The answer is kind of like, oh, we don't really know. So we thought, well, let's show an idea on exactly what you would possibly do when you think that markets are fully valued or expensive. And this doesn't have to be a permanent change, but this will show you how you can get nice, strong return on your investment going forward when you have otherwise expensive markets. So we're going to take a pretty well-known name. We're going to look at Tesla. So we just priced a note. This is a structured note that will trade around Tesla. And what it does is it's a contingent income note. So what it will do is it's going to be range bound. So what it's going to take into effect is that as long as Tesla trades inside this range, you will get 20.97. Now this is not a live note. This is something that we are pricing, so it changes day by day, but it's anywhere in that range. But 20.97% per year as long as Tesla stays in this range. So what is that range? This is the current market value. This is minus 45% from the current market value. So even if you had comments where Tesla is an amazing company, going to change the world, awesome technology, well managed, etc., it doesn't mean that they don't eventually get expensive, and that's probably where we're sitting when we're around $800. But you also realize that it's probably not going to trade much lower than $450 or something around that range anyways, even if it sells off completely. So how these notes work is that, so this particular note is going to be 3 years, which means if it stays within this range for 3 years, you're going to get 20.97% for 3 years. That's almost 63% return with the market not having to be appreciating. In fact, you'd rather it be flat. Now let's say what are the opportunity costs? So the market surges higher and it goes above 20.97%. Not likely going to happen, but let's say it does. Then I don't think anybody's going to be disappointed with that type of result. However, let's say that Tesla, for that circumstance, looks more like this. This is kind of where it's doing, is bouncing around, and then eventually it cracks this barrier. That is where those coupons would stop. So you would get the first, let's say it took 6 months, you would get 6 months worth of coupons at that percentage. So obviously if it's, call it 1.5% per, I guess it'd be a little more than that. It'd be just, almost just about 2%, I guess, but 2% per month for 6 months. Well, it's still a 12% return. 12% return to not be susceptible to a major sell-off in the market. Best case scenario, it stays within that range for the 3 years. You clip the coupon all the way through. You're left with almost a 63% return, which is going to beat most market performance over a 3-year period, hands down, but you're still protecting. Also, as long as at the end of this 3 years, you are above minus 45%, there is no risk to your capital. You get 100% of your capital back and all of the coupons as long as Tesla trades within that range. So what's nice is where you want to start is that if it starts to trade like this and goes sideways for a long period of time, which is probably what we're going to experience with markets, it's going to be a perfect storm for these contingent income notes. So we haven't really showed a lot of exact detail on these in the past, but I thought, rather than have people continue to think about where to go when the markets are expensive, we thought we'd show you clear options and opportunities and exact investment strategies that you could look to incorporate in your portfolio. And so these are a different type of thing, but they work really well. They work like clockwork. We've been doing them for many years with our clients, and always during this moment in time when the market is expensive. You definitely would never want to look or consider into these if the market is in all-time lows, like say last March, because it's just going to get called away and you're going to leave up too much upside. Those would be more geared towards marathon notes and different securities. But anyways, there you have it, how you can clip 20% return from Tesla without having to worry about the market price.